Good evening, everyone. Great to see you guys on Zoom tonight. Okay, hope you guys had a good day today. For those of you who are joining us for the first time tonight, this is our usual monthly short Zoom sharing session where we will talk about the recent market events and share our insights on the stock markets, right? So do join us on time if you're able to, because usually such sessions, they are kept short, within 30 to 45 minutes. So if you join us late, then you might miss out on some of the parts that we share. Okay, while we wait for more people to join us on Zoom, just a quick disclaimer over here. Anything that we share tonight, it is not financial advice. They are just my personal opinion, and this sharing is more for educational purposes. So before you make any investment, the usual rules apply. Please do your own due diligence, okay? Okay, so this is the agenda for tonight's webinar. The first thing that I will cover about and talk about is the U.S. debt ceiling situation right now, the topic of the U.S. debt ceiling situation. What is it all about? Okay, and how would this affect the stock market, and how does this affect investors, or how should investors actually navigate this event? Then the second thing on my list, on my agenda tonight, is to talk about this, focus on this banking crisis. But the focus today is not really on the US banks, but more on the Singapore banks itself, which we have seen that there have been some pullback in the stock prices for the three Singapore banks, which are DBS, UOB, and OCBC for this year, since the onset of the banking crisis that happened in the US. So is it still safe to invest in the local banks under such a situation, given all this recent banking saga? And how can investors actually move on to identify appropriate price to buy the Singapore bank stocks, right? If you are interested, you are looking to also invest in some of these bank stocks because of the attractive dividends that they provide. Okay, so this is the agenda that I will cover for tonight's sharing. But before I go on, I would also like to hear about your thoughts on how you have been investing in the US markets and also in the Singapore banks. Okay, so let me now launch a poll. Can you guys let me know about your thoughts by answering the question in the poll? So let me know how you have been investing in the stock markets, in the US market, and also whether yourself you have been investing, have been buying Singapore bank stocks, or whether you're actually looking to buy or you're totally not interested to buy at all. Okay, so just let me know how you feel, right? And how you have been investing. Okay, so I'll leave the poll for a while for you guys to read the questions. Okay, keep your answers coming in. Okay, based on what I'm seeing right now, most of you, the majority of you, about 70%, you have been staying invested in the US stock market, even with all this, negative news, bad news, recession, debt ceiling, and so on, right? Most of you are actually still in it. Okay, a minority of you are keeping out of the market, waiting for that final crash, final bottom before you go in. Okay, and there are some of you have not started investing in US markets yet, but majority of you are actually staying invested. Okay, that's good to know. Second question, Singapore banks. Okay, so some of you, about 64% of you, have bought Singapore bank stocks before, and you are looking for more opportunity to actually invest in even more shares of the Singapore bank stocks. Some of you have not yet started, but you are hoping to, about 18%. Not yet started, but hoping to actually start buying Singapore stocks. Okay, let me end this poll here. Okay, so with that, let's start on with the first thing on the list. Okay, so recently there have been a lot of news and content, if you read online, whether it's articles, videos, right, in all forms, they have been talking about the topic of the US debt ceiling and how a default may result in catastrophic impact on the economy, right, and the stock market as well. So there are articles that talks about how US equity funds sees massive outflows because of the debt ceiling worries, and also there is an increased demand for hedges against a sudden increase in volatility, right? Where there are more people using options, they are buying protection using options because they are worried about a further market decline. So these are what we have seen in the headlines and also the contents online. So what is this whole debt ceiling about? And will it cause the stock market to really decline? So let's understand further. Okay, so firstly, what is the debt ceiling? Now, the debt ceiling is actually the limit for the total amount of debt that the US Treasury is authorized to borrow so that you can fund for all your government spending, like they spend on areas like social security, areas like military budget, and so on. Now, you may be wondering, doesn't the US government collect taxes? Doesn't the US government have other sources of revenue? How come there is this worry about breaching the debt ceiling? Now, that's because often the US government is spending more than it collects. So therefore, if you're spending more money than you collect, then you earn from the revenue, then you need to borrow money so that you can fulfill your obligations, right? And that's why the US Treasury must issue debt to pay for the outstanding obligations. Now, if you take a look at this chart over here, this chart shows the total US government debt over the years since the 1990s, okay, since the 1990s. And right now, we are approaching the 31.4 trillion debt ceiling. Okay, so you can see that this US government debt has been growing over the years, right, since the 1990s. So what is going to happen? The question is, what's going to happen now if, say, the debt ceiling is reached, right? Then what's going to happen? So typically, what's going to happen is that the US Treasury will use extraordinary measures to avoid defaulting on the government obligations. For example, some of the things that they could do is they could prematurely redeem the Treasury bonds that is held in federal employee retirement savings accounts and so on. Okay, it might sound very cheap, but that's okay, okay? So that's what the Treasury, they will try and find some measures, right, to avoid defaulting on the government obligations. Then on the other side, on the other hand, we have the Congress. Now, the Congress is responsible for raising the debt ceiling. Or it can also choose to suspend the debt ceiling, temporarily allow the Treasury to supersede the debt ceiling. Now, in fact, since the 1960s, the Congress has already acted 78 separate times to either permanently raise or temporarily extend or revise the definition of the debt ceiling. Okay, so this is the situation that will happen if the debt ceiling is reached. Now, so the question now is, since it's rather common to raise the debt ceiling based on history, right? Then what is the issue now? What is the issue now? Can't the Congress just raise the debt ceiling again? Okay, so here's the biggest problem. Now, the biggest problem is politics again. So the biggest issue is that this debt ceiling has always been used as a tool, as an opportunity for the politicians to seize political gains. So historically, what happens is that the Republicans will oppose to the raising of the debt ceiling unless it comes with a cut in the government spending. But based on how all these historical debt ceiling sagas went, eventually the debt ceiling will be raised. Okay, that's what we saw in history, like eventually it will be raised. Okay, and that's how the US government debt has increased tremendously over the years, as you have seen in the chart earlier on. But how easy or how difficult it is to reach that consensus for the Congress to raise the debt limit, it will be a political play. So this is the problem right now that they're facing. It's all about politics. So the most famous example that we have seen in history was back in 2011. So what happened in 2011? So back then, the Republicans used the raising of the debt ceiling to force President Obama, the then president, for government spending cuts. So eventually the deal was reached, but it was reached only 2 days, just 2 days before the Treasury was expected to exhaust all its effort. And because of that, the US credit rating was downgraded for the first time in history from AAA to AA. Okay. And as you have expected, right, stock market came under pressure, right? Stocks came down. So let's take a look at how the stock market has performed in 2011 because of this whole event. Okay, so back in 2011, if you look at this chart on the left, the graph in red is showing the price, the S&P 500 price for 2023. The chart in the grayish blue color, that is showing the 2011 S&P 500 performance. So if you focus on the grayish blue color one, you can see that since the start of the year, right, from January until when we reach August, the S&P 500 plunged by more than 15% over here. Okay, and if you look at the various performance of the various indices, from June 2011 to September 2011, you can see that most of the indices, they are down as well, right? Down by more than 10%, some down by more than 20%. So this was the performance of the stock market back in 2011. So the stock market was put into pressure at that time. And we also see that some sectors, for instance, the financial sector, it was actually more badly affected as compared to other sectors. Like in this case, financial sector was down by about negative 24% from the period from July to September 2011. Whereas consumer staples, on the other hand, which is this one, it was down by just about 5% compared to 24%. So some sectors held up better than others. So this was the situation back then in 2011 for the stock market. So some people, they're actually saying that, okay, so currently this current political situation that we are experiencing in 2023 is similar to 2011. Okay, similar to the 2011 situation where they nearly default on the debt. Okay, because why? Right now we are also nearing the X date, which is supposedly in early June, right? But the negotiations between both parties, they are still not settled at this point in time, even though we are near the X date already. So let's analyze the 2011 situation to get some insights on what might happen on 2023. Of course, I'm not saying that it's going to be exactly the same, right? Because nobody can predict that. But let's try and look at what happened in 2011 to gain some insights and let us understand what might happen for 2023 if 2023 situation is very similar to 2011. So if you look at this stock chart, this is for S&P 500 that I've pulled out since 2011 until today, 2023. You can see that even though there was a decline, right, the stock market plunged by more than 15% in 2011, but over time, the S&P 500 actually rallied up by more than 200% over the long term. And in fact, it managed to go back to the July 2011 prices by the following year in January 2012. So you can see that eventually the stock market recovered, the S&P 500 recovered, even though there was this, whole debt ceiling crisis, and the stock market actually went down because of that. So if you ask me, eventually the debt ceiling would be raised because otherwise a default would actually undermine the consumer and also the business confidence, which will then hinder the economic growth, of course, right, of US. And it will also destabilize the entire global financial system, where a loss in confidence of the dollar, it can have more far-reaching economic and foreign policy ramifications. So such ramifications, they're actually too serious, right, for both parties, the Democrats and the Republicans, who actually want to see a default, which is why over the history, there are so many examples where eventually the debt ceiling is raised, right? Even though they are trying to play this political game, one side trying to force a cut in government spending before they agree to the raising of the debt ceiling. Now, so the question for us investors is that we should be thinking is, what can we get out from this event? Now, if in the event that there is really more volatilities in the stock market really come down, S&P 500 come down, individual stocks come down, what can we get out of this? So the answer is, if it does happen, right, we can get to buy the stocks at a lower price. Because you know that ultimately, when the issue is resolved, we saw how the stock prices actually recovered, right? We saw how the S&P 500 actually recovered, rallied up by more than 200% over the long term. So in the grand scheme of things, this will just be a blip, right? Eventually it will recover because once this issue is resolved, the businesses, the companies are still doing well. The S&P 500 companies are still doing well. Over the long term, the price should still go up, right? So we learn to adopt an opportunistic mindset right? Opportunistic mindset during market volatilities. And that's how we can then get to buy stocks at low prices, right? So that's a great view for us if it does happen. I'm not saying that it definitely will happen or it wouldn't happen, right? I can't predict that. Whether the stock market will actually plunge down by more than 15%, like what happened in 2011 for this time around this year, I can't predict that. But in the event, if it does happen, it's not something that we have to go panicking about. Okay, but having the right opportunistic mindset alone is not enough, right? You need to know what to do. I can't say that I'm very optimistic about this. So that's not enough. I need to know what to do, what to act when the opportunity comes. So a stock investor has to first, number one, know what to buy, right? What stocks to buy. Because today, if you took hold of this opportunity, you go and buy into fundamentally weak stock, where the fundamentals are poor, the loan price can get even lower, right? You have so many examples where stocks, the price a low price you thought is very low already, it can get even lower, right? But on the other hand, if you buy quality businesses, then your win rate is almost as good as 100% in investing over the long term. In the short term, definitely there'll be ups and downs, right? There'll be fluctuations in the stock market and your portfolio will be impacted. But over the long term, if you're investing in the quality businesses, then your win rate is almost as good as 100% over the long term. That's the first thing that you need to know what to do, right? The second thing is, at what price do you want to buy to maximize your profits? Okay, so why is this important? Because it is a step to help you to maximize your profits. Let me give you an example to understand more on this second part. Okay, so this example is not stock market related. It is just something that happened in our everyday life. So let me share this with you. Okay, this happened in my everyday life, right? So just like recently, I saw that there was this 1-for-1 promotion going on at Guardian. Now, you guys all shop at Guardian, right? For a brand of facial mask that I've been using all along, right? And that I really like and I have been using for many years. Now, so seeing this deal, this 1-for-1 deal, I acted upon it and I bought some facial masks recently. That was just in May, right? This month only. So what is the reason I was able to act on the promotion swiftly when it came? It's because number one, the reason one is I knew that I would still continue to buy this brand of facial masks in the future, right? And my supplies have been running low. So it has actually been in my watch list. I have been watching out for this. And number two, based on the past pricing history of Guardian, I know that Guardian actually pushes out this 1-for-1 promotion a few times per year. So that way, what I'm able to do is I'm able to make some cost savings and thereby, of course, increase my personal net income. Now, obviously, this is not a huge amount that we're talking about. There's not a huge amount of savings that we're talking about. But that is something that I would like to share with you in terms of this thought process, right? So the thing that I'm sharing with you is a thought process. So now let's go back to the stock markets and apply. So ask yourself, how does the example for Guardian, right, buying facial masks, how does it relate to the stock markets? Now, in the stock markets, the way I make my purchases, the way I make my investments is that firstly, the first step is I would build a stock watch list. Okay, a stock watch list that is already ready that is filled up with stocks that I like, that are fundamentally sound, that I think they are good businesses. They are making money, right? They have very good cash flow, no cash flow issues, okay? Things like that. They meet all the criteria, right? So these are the stocks that I am confident about. And I know that, okay, in the foreseeable future, they are likely to continue to do well. Of course, there's no 100%, right? Things may suddenly happen, but likely they're going to continue to do well. So this is the first step that I will take. Now, but I also don't want to just, blindly or randomly buy at any price, right? Because I'm not in a hurry. Okay, I'm not in a hurry. So instead, the second step that I'll also do is I will go back to the stock chart to look at the price movements and analyze it, where I will identify certain high probability price levels that tend to be revisited during corrections or during market crashes. So these are the price levels where the stock prices tend, when they retrace, when they have a pullback, they tend to revisit those levels before they do a rebound up during corrections or during crashes. Now, usually different stocks, they will retrace to different levels. Okay, there's no fixed level. Okay, it depends on the stock. And they will do this at different point in time, unless you're talking about an overall stock market crash, like during COVID, where all the stocks come crashing down. Then yes, they will come crashing down at all at the same time. So because usually under normal situation, they come down, they retrace at a different point in time. So this allows us to buy stocks at different periods in time. So over time, right, most of the time I would find that what I'm able to do is I'm able to buy different stock counters at different periods of time in a year. Okay, so this is the whole, how I apply the entire thought process to the stock market. So for example, last year in November, during the webinar that I held in November, I actually talked about Procter & Gamble. So for those of you who were present during the November webinar, you may be familiar with this. Okay, so I talked about, this is just a screenshot from what I showed back in last year November webinar. So back then I talked about support levels that you can identify for Procter & Gamble or the stock chart. Okay, so for those who are new about this, so let me just do a very quick explanation. So support levels, what are they? They are price levels where prices have the tendency to actually rebound. That means go back up. After you come down, you have the tendency to go back up. Okay, and the reason is because there is sufficient buying power to drive out the prices. So how we use support level is we like to buy when prices retrace to the support level, because once it goes to that level, there's some kind of like a support, the price will actually rebound back up. So using Procter & Gamble as an example, right? So this was shared back in November 2022, and back then when I shared, we were already at this point where the stock price actually crashed the bottom in October, and then it started rallying up. So we were actually at this point during November. So after a few months, now we are in May 2023 already. Let's see how this how the stock prices for Procter & Gamble have moved and whether it actually works or not. Okay, so all these horizontal lines are the respective possible high probability levels, support levels that we have actually identified. And you can see that at point A, this was where the stock price actually retraced after it hit the 125 level during October last year, and then it went all the way up. So many investors, when they see this, they will feel very happy. They will start buying here, because they think it's only going to go up, right? We tend to extrapolate what is happening. When it goes up, we think that it will continue to go up. When it goes down, we think that it will continue to go down. So don't dare to buy. Now, but what happened is when it reaches here, okay, there's some kind of resistance and it actually came back down. Let me draw. So you can see over here at point B, right, the prices actually retraced. And where did it retrace to? It retraced to this level, which is the around 130, 35, 36 level, okay, which is one of the support that we actually identified last year in November, okay, and then it actually rebound back up. Okay, so right now, it seems that it's going to go through another pullback right now in the stock market. Okay, so comparing point B and point A, I look at these 2 points now. At point A, I would not be interested to initiate a position. Initiate a position means buy lah. Okay, buy more shares of PG, because based on this stock chart analysis, there is no reason, there's no analysis that can support the decision to buy at that point, right? That means there is no reason, doesn't make sense to buy at that point. So as compared to point B, now if you look at point B as compared to point A, right, I would rather buy at point B because there's a reason why it retraced to one of the support levels, right? So this is just one example of how we make use of stock chart price movement analysis to help us to identify, okay, at which price level would I actually ideally want to buy? And by doing so, it would help to maximize my profits over the long term, because I don't just randomly buy, right? But I try to buy at prices where it is reasonable and there is a reason, there's an analysis that supports it. Okay, so this is just an example using Procter & Gamble. Now, usually at this point in time, there are two common questions that investors will ask at this point in time. Now, one is, what if I buy at B, but prices continue to come down? So right now we saw that after B, right, prices went up. But what if the situation isn't this? And it turns out that prices continues to retrace down, continues to do an even deeper pullback from point B. Now, this is where you have to split your capital and buy in stages. Now, for those of you who have been joining us for our webinars for a few times already, you may have heard me say this, repeat this a lot of times. Usually when we buy, we don't just throw in all our money at one shot. Now, we split the capital, we buy in stages. So the reason why we split our capital and buy in stages is because, after all, we can't control how much Mr. Market wants to retrace, right? That is not something that's within our control. So we don't throw our funds all in at one go. So that if, let's say, the price go down to the next lower support level, I still have money to actually buy in. And that way, that can help me to average down my cost price in the event that the share price falls further to the next lower support. Or in the event, there is a sudden crash again and then prices go down to the next lower support. I still have the capital to buy. So we never just throw all the capital that we want to invest all in at one shot at just one price, because we never know what might happen next. All right. So why we do that is so that we can actually average down our costs over time. So this is the first common question that many investors will ask, right, when I share about stock chart analysis. The second common question that many investors will ask is, what if share price retraces only a little bit and it doesn't hit any of the support level? Like in this case, it actually retraced until here, right, which is the support level, and then it will go back up. What if it only retraces a bit like that, then go back up already? So what happened? Now, what I will do in such cases is I will not chase after the prices, meaning to say I will not just buy at all these prices when it goes up. Now, the reason is because usually after a rally, right, after a steep increase, especially a steep increase, it has to go through a deeper retracement at some time. Because if you go and study, if you look at past historical stock chart price movement, stock prices, they do not go up in one straight line indefinitely. That's not how it goes. It has to go through ups and down, like this, right? So usually I'm not going to chase after the prices. Just like if you can still recall back in the first half of the year for 2021, okay, that was when we had the recovery from the stock market crash, right? So a lot of investors were getting very greedy, thinking, wow, the price keeps going up, it can only go up. But that's not true. What happened after that? It started to retrace, right? So come 2022, the stock market went through deeper pullbacks, which eventually turned into a market crash. So it pays to make your stock purchases, at better prices and at more appropriate points, so that you can maximize your long-term investment profit, so that you make good use of your money, of every dollar of your capital. Now, along the way, there'll be plenty of reasons that the news media can come up to justify a market crash or a market correction. Like we started off with the Russia-Ukraine war, and then after that, it turned into inflation, rate hikes, recession. Then now we have debt ceiling. After debt ceiling, you go back to another thing. It could be sticky inflation and things like that, right? So there will always be a reason, okay, for stock market to come down, right? So this can then become opportunities for us to tap on and to buy the stocks that you want to own, that you want to invest in at good prices. And this is also the reason why we build a stock watch list, because you don't just invest in one stock, right? Most of the time, right, most of the long-term investment success come not just from one stock. It is not built from just one hit wonder, but it comes from a couple of good stock picks that you make. So if you actually have a stock watch list, you'll find that even if I don't buy this one stock, I could still have opportunity to buy other stocks. I mean, I could put my funds into other stocks, right? So that is why we will build a stock watch list before we start investing, right? Okay, so that is what I want to go through for the first item on the agenda. The second item on the agenda is the banking crisis, right? Which I'm sure you guys have heard about, right? It is the talk of the town, right? Banking crisis in the US. How it started is, it started with the fall of Silicon Valley Bank and also Signature Bank, which were actually the second and the third largest US bank failures since 2008. So this was back in 2008, right? The total asset size of those banks that failed. And this is in 2023. Okay, you can see that it is actually the second and third largest US bank failure since 2008. And this is not all. After this, we had First Republic Bank, okay, in May this year. And not to forget also about Credit Suisse, which actually had scandals and reputational issues over the past decade. And it has been actually reporting losses, financial losses. But when investors don't assess the financial figures of the business, when they don't look at the financial figures, they tend to make judgment based on their impression of the brand. Like Credit Suisse is actually a very good example. There were many people who were surprised at the Credit Suisse saga because they did not know that actually Credit Suisse has been making losses, right? So they hear the brand Credit Suisse, they think it's a very big bank. So they didn't think that such issue would happen to Credit Suisse. Okay, to quote you a local example in our Singapore context. Now, in Singapore, we have businesses like Singapore Airlines, we have Singtel, which many investors will think, oh, it is definitely a good investment because of local buyers and because we like the brand as a consumer. Like I like to take flights from Singapore Airlines, although recently they have all those in-flight meal issues that were being complained by the passengers. Now, but when you assess the financials of these businesses, when you look at the industry type, then you may not be as keen to explore these investment ideas. Okay, so a lot of people, they just use their impression of the brand to decide whether they want to invest in the company, which is not the right way to do. So coming back to this topic of banking crisis, so because of this banking crisis in the US, it has also triggered some sell-off for our 3 local banks, right? DBS, OCBC, and also UOB that are listed on SGX. Because people were worried that would this actually have some impact on our local banking sector? So what we saw is, okay, so this chart is as of 19 May, not of today. The stock price of DBS, okay, and UOB, which is the one in red and the one in blue, they have been down about, here is 9% right? But as of today, it's about 7 or 8% around there. And for OCBC, it is about break even for the year, right? So it started the year with some gains, but it lost the gains during the year after this banking saga. So it actually gave up all the gains, almost all the gains for the year. Now, so the question now that you guys are probably thinking is, so is it safe? Is it safe to invest in the stocks of this Singapore banks and take advantage of this pullback to buy at better prices now that they are coming down, right? Now, first we got to understand about the nature of banks, right? Banks, they are actually highly leveraged, right? Banks are highly leveraged. Even more so than other sectors, than other sectors that we have. Okay, how banks make money is most of their money they make by actually lending out. So they lend out the money to earn higher interest than the interest that they pay to their depositors. So when assessing the risk, right, we got to look at different areas, right? One of which we actually talked about before, is the capital adequacy. So we mentioned this before in one of the webinars, right? And one of the ratios that you can look at, of course, is the CET1 ratio, where the banks are actually required to report. It is mandatory for them to report and to maintain within a certain threshold based on what the regulator set. So what the CET1 ratio tells us is basically how well a bank can actually withstand the financial stress, right, and remain solvent. So as a general rule of thumb, of course, the higher the ratio, the better. So if you look at the CET1 ratio over here, you can see that DBS, UOB, OCBC, they have about 13 to 15%, right? And if you want to have some comparison, right, if you compare against JP Morgan, right, the biggest bank in US, you can see that our local banks are actually comparable, okay, in terms of the CET1 ratio. And this is definitely also well above the regulatory requirement that is set by MAS. Now, all this CET1 ratio is readily available. So you can just do a Google search, you can find it because they are supposed to report, okay? They are supposed to disclose. So you don't need to do any calculation yourself. Don't need to understand how to calculate, okay? That is too cheap already. Okay, so that's one thing that you can look at. Now, the second thing is now, because banks, they are also highly exposed to changes in interest rates. They are highly affected by changes in interest rate. Now, for example, what happened to Silicon Valley Bank, SVB, is that they put too much of their funds into the long-term bond, right? Then because right now we have high interest rates, right? We have rising interest rates. So because when interest rate rise, the value of the bond investments will fall. Okay, so they fall below their maturity value, but SVB is being forced to liquidate those investments at a loss so that they can raise cash to pay back the cash to their depositors, right? Because the depositors actually withdrawing the cash. So what we want to look at is also whether the securities as a percentage of their assets is at a reasonable level. So for example, SVB, you can look at it, it has a percentage of 57%, which means to say that 57% of their assets were put into securities like long-term treasury bonds. So they are highly affected by changes in the market interest rate. Okay, as compared to SVB, if you look at our local banks, right, we only have a percentage between 12 to 18%, 12 to 19%. Okay, so this is another area that you can actually look at when it comes to all the risks that you want to assess for banks. Now, of course, when it comes to bank, you can't run away from this. This component is very important, which is trust, reputation, and the trust. It is very critical in the running of banks. So in Singapore, the good thing is that we have MAS, which adopts a very strict regulatory framework when it comes to compliance for banks to meet all the minimum requirements that is set out for all the financial ratios. In fact, during the AGM for DBS this year, there was an investor who talked about how actually Credit Suisse had very comparable CET1 ratio as DBS. So does that mean to say DBS is also at risk as well? Now, so the CEO of DBS actually clarified that actually different regulators, they in fact apply slightly different standards when they calculate all these ratios. So in fact, MAS also adopts an even stricter computation of these ratios. So trust is something that's very important because if you look at Credit Suisse, it is a very good example. It's a very good illustration of a bad example. Why? Credit Suisse, it has actually run into many scandals, multiple scandals over the last decade. But many people actually don't know about it. They thought Credit Suisse is a big brand, it's a good brand, right? They had many scandals over the last decade, and actually people are losing trust. The depositors, the investors are losing trust in the bank. The moment trust is lost, then people will start pulling out their funds from the bank. And that's where shit happens for banks. All right. So for our local banks, coupled with the fact that they actually have very stable financial results for our 3 Singapore banks, they continue to perform well financially, where their total revenue for, if you look at 2022 versus 2021, revenue actually increased by between 10 to 18%, right, for their revenue for the 3 banks. And if you look at the net profit, it also increased by a double digit, between 12% to 20%. Now, in fact, DBS Bank also posted a ROE of 15%, which is actually ranked among the 8th, right, among the world's 100 largest banks. And that's actually a very creditable feat because Singapore is not a high net interest margin market, unlike the United States. So the 3 local banks, they have been performing well financially. They continue to post very stable financial results. And of course, they are well known for their attractive dividends, right, that they distribute to the shareholders. So their dividend yield continues to stay at remain at attractive levels between about 4% to 5%, right, with the dividends per unit increasing and recovering from the pandemic, from the COVID times. Okay, so the next question is, at what price do I want to buy the stocks of Singapore banks at? Now, one way for banks is you can look at PB ratio. For banks, generally, we look at PB ratio over PE ratio because it takes into account the value of the bank assets, right? And it also offers us a perspective of the performance of the bank with respect to the efficiency of their utilization of the funds. So if you look at the PB ratio for this is as of 18 May when I extract all this data, 1.36 for DBS, okay? In fact, for all 3 banks, they are actually above the 5-year average. If you take 10-year average, it's also above that right now, currently for all 3 local banks. Okay, so from this perspective, what it means is that actually it is still not considered cheap or value for money yet at the current pricing for the Singapore banks. So overall, all these 3, they have the current valuation to be above their respective 5-year historical average, okay, or above their 5-year average. Now, but usually I only use PB ratio as a rough guide now to let me understand, okay, roughly what's the valuation right now, okay? But when it comes to the exact price level, or when do I initiate a new position to buy more shares, right? I always go back to the stock chart to tell me what to do. Just like what I shared with you for the Procter & Gamble example that I talked about earlier on. So let's take a look at DBS stock chart first. Okay, so you can see here, there are many lines drawn over here, okay? It may look very confusing at first glance, but let me just go through it one by one with you. So let's focus our attention on the first line, $29 here first. Okay, if you focus on this, how we identify this horizontal support at approximately $29 is if you look at in the recent years, right, the last 2 years, when the prices actually hit this level, it rebounds up, right? Then when prices hit this level, it rebounds up. So there is some kind of a support at $29, somewhere around there, okay? Support is a zone, and it's not a fixed level. So this is just a roughly, I tell you 29, okay? Now, if we move back in time some more and look at the price movement now, we can identify the next lower support at somewhere around $24 over here, right? You can see when prices hit this level, they actually go back up, they rebound back up. Right, and the next one would be at $20, okay, and this $20 is in fact a resistance last time. If you look at this area that I just circled, okay, this area is a resistance which turned into a support during the COVID crash that we had in 2020. So this is the next lower level. Okay, now so all this that I draw, they are the support levels which are potential entry prices to buy the DBS stock at. So okay, let me just share with you my personal opinion, right? Okay, this is not for you to follow, just my personal opinion. At the support level, the first support level of $29, frankly, I may not be that keen to initiate a position. That means I may not be as keen to actually buy at $29. The reason is because we saw the PB ratio, right? It is still currently on the higher side, but we're actually we are somewhere near this level already, but the PB ratio is still on the higher side, more on the more expensive side. So at 29, I would not be as keen to actually buy now. So I'll be looking at lower levels, somewhere maybe around 24 and so on. Now, of course, if prices retrace to 20 level, that is a bargain price to buy at. Now, some people will say, how is it possible? It can never go back to $20 already. How is it possible to drop so low when it has gone up to 30 plus? Now, the thing about bank stocks is you have to understand what is the nature, okay? They are very cyclical. Okay, they're very cyclical stocks. So they tend to exhibit very huge price movements, or you can say cyclical stock price movements over time, especially during crisis or where there's negative sentiment in the stock markets. Okay, that is when the stock price will then retrace, they revisit the price level that you can last seen many years ago. Okay, so for example, if you look at COVID crash, this level, somewhere around $18, when you last seen that level is somewhere in 2016. Okay, so when there is negative sentiment surrounding the markets or the industry, the particular industry, the prices can actually fall considerably from the peak. Which means to say, for such stock, personally, I would like to actually have a greater margin of safety when I'm dealing with such stock. Okay, because the fall in the asset price can sometimes actually negate the dividends that I collect. Okay, in other words, I'm collecting the dividends to cover up my losses for the capital losses. Okay, so it is not that these stocks are not good to invest in. That's not true. Okay, but most people, when they buy them, they tend to buy them randomly at any price point, even though it's at the peak. I also just anyhow buy. But the thing is, what it means is that the dividends that you collect is actually being used to cover up your capital losses when the stock go through all this huge price movement, because banks are very cyclical. Okay. Now, but of course, when exactly would it actually go back to $20? I never know, right? Nobody knows because we don't have a crystal ball to predict that. We can only do the analysis and we keep that in mind so that if it happens, that, okay, if it happens, I can act on it already, right? I know what to do. I can average down on my cost price, even if I actually have bought it at a higher level, but I know what to do, right? So this is how the analysis will help us over the long term. It is not just for right now, right? But when you do all this analysis, it can bring forward to the future as well. Now, so in fact, there's also this line over here that you call the trend line. Okay, how we draw the trend line is we just connect the lows, okay, the historical lows together, all these lows, and you try to connect as many of the points together, and you form the trend line. Now, so you can see that the trend line also it's also somewhere near the $20 level. Okay, so but please don't get me wrong. I'm not saying that there will be a crisis or because of this debt ceiling or anything. The market will go through a huge pullback. That's not what I'm saying. But in the event if anything happens and it comes back down to such low levels, I'll be very happy to buy, because that would be a bargain price to buy it, right? So this is for DBS stock. Okay, I saw one question. Let me see. Why do you sell? Let me. Why did you sell the Singapore bank shares right after they announced a strong set of results? Okay, so you see, when you sell a stock, there can be many reasons, right? Of course, one reason is where you must sell. Okay, that is when the fundamentals have worsened, right? That of course you must sell to sell off those shares, right? But another reason that sometimes why you may sell shares in the stock market is because we need the funds to put into other stocks where we deem that there is a better opportunity. Okay, where we think that they are actually at very good prices, but the fact is that most of us have limited capital, right? We have limited money to work with. So for SG bank stocks, for most of them, right? Why did we sell? Is because they were actually at. Okay, let me change it. They were actually at resistance levels, right? Which was the reason why we actually sold some of the shares lah. Okay, but just sharing with you. Okay, so the general thinking as to when do we sell a share? Of course, number one is where the fundamentals have worsened, so you don't want to hold the share anymore. You don't want to own it. You don't want to invest in it anymore. Number two, the fundamentals have not worsened, but it could be a case where you think that there could be limited upside, or you have other better opportunities where you want to put your funds into, because after all, we have limited capital to work with. All right, and most often what people do is when they see a strong set of results, a strong set of financial earnings, then they start to buy. But usually that could be too late. Why? Because that's where the prices start to jump right up, right? Just like if you look at Nvidia, they have actually, if you look at the pre-market today, I think just now I saw it was up more than 20%. So people start to buy after they see good earnings. Okay, but most often when you do that, you end up buying at very high prices. But if you already know that this is a stock that has good fundamentals, now when the prices are beaten down, when you have opportunities, that is when we would like to buy. So in fact, that is like a contrarian view, contrarian thinking, where we buy when people don't want to buy. But when do we sell? We sell at a higher price where everyone is rushing to buy. So I actually shared this before in some of our webinars lah. Okay, next. So that is for DBS. Let me share one more, okay, before I end off for today. Let me share for UOB. Okay, so for UOB, the sheet is very clear cut. Like you can see this somewhere around 24, right? So it was previously a resistance over here back in 2008, 2007, and also here, and then it became a support over here. So this could be a good support level where I may look to enter and buy again. Okay, so the reason why it is important to be buying bank stocks at appropriate prices or appropriate price level is because, as you can see, they go through actually large cyclical movements, right, for bank stocks. So you can look at all the 3 Singapore banks. They are very similar. So for such stocks, cyclical stocks, we don't like to buy at the peak. If not, like what I've mentioned, the dividends that you collect is actually being used to offset your capital losses, right? So this is also the reason why there are some investors, after they invest in the bank stock for some time, they still find that, hey, how come my overall return is still not as desirable? That it's not what I've expected. Because sometimes when you randomly buy at, just nice you buy at the peak, and then it goes through a huge cyclical price movement for over the years, right? The dividends is being used to actually negate all this capital losses. Okay, so if you want to draw a trend line for UOB, right, this is how it would actually look like. Okay, so we also have a trend line over here. Oops. Okay. So all this are actually potential entry points, and this is how we actually analyze the stock chart to help us to make more informed decisions. We don't just randomly buy. In fact, different stocks, they have different characteristics, different features that you can look out for. So this is for bank stocks. Now, so if you want to learn more on how to actually do stock chart analysis, use a range of tools, you can also join us on our upcoming workshop. This will be held in June. Okay, so during the workshop, we will then spend more time to go through the basics of analyzing the stock chart price movements, how you can actually do that to help you identify appropriate price levels to buy and also to sell, right? If you're looking to sell, I don't just randomly sell, but how do I actually sell at a better price, right? Instead of just doing this randomly at any price level. So all this is to help you, guide you to make more informed decisions to maximize your profits over the long term for your investment. So this workshop is conducted on a face-to-face setting. It is not over Zoom like this. It's not. It's in a face-to-face setting where the learning is more conducive. And this will be held on 25th June, a Sunday afternoon. Okay, so if you are keen to learn more, you can scan the QR code over here, or you can also take down this website link, because from time to time, we actually update with new workshops. So you can just save the link as well. You can revisit and check back on the web link in the future for other workshops that you may be keen to actually sign up for and learn more, right? So that's the end for tonight's market sharing. I hope you have learned something from what I've shared tonight, from the two agenda that I went through for today. So if you find our Zoom sharing useful, do join us in future sessions, and be sure to subscribe to our Telegram channel so that you will receive the notification, because usually we'll definitely post it out on our Telegram channel. Sorry.